Hey, good morning and welcome. My name is Matt Price. Randy Price as well is in another meeting, so stuck with me today it looks like. But we'll be talking about creating income for retirement, a pertinent topic for a lot of people as they do approach retirement. And we have some what I think are useful educational slides to discuss. So let's go ahead and jump in. Who are we? Randy Price. He tried to tell you he's my older brother, but he is my father. We serve as a fiduciary for our clients, 45 plus years of experience between the two of us. And over 80% of our clients are retired. So this is a niche for us. We're not trying to be all things to all people. Retirement is really what we do weeks, nights, and holidays. So a little bit about our firm, Steward Partners, based off the biblical definition of stewardship. Raymond James is one of our 3 custodians that we can use. I think it's important. I already mentioned we do serve as a fiduciary. We think that's one of the most maybe important considerations if you are looking to hire an advisor. If they do that, it's hard, if not impossible, to do that if you work for a bank. So that's not us being rude. Have a lot of good friends and that work at large brokerage firms or banks, but it's just very hard, if not impossible, to serve as a fiduciary for clients in that capacity. A little bit about who we are. Randy's received a number of awards from Barron's, Financial Times, Forbes over the years. Both of us are certified financial planners. We both went to Wharton School of Business to get our CIMA, Certified Investment Management Analyst designation. Hopefully you're following along with some of the blogs we put out with our Retirement Insider weekly email. We try to really ramp up our communication when markets are choppy like we saw last year. If you're not on that, happy to add you. Just shoot me an email after this presentation. So we're going to talk about a few different things. We're going to warm our brain up, give a quick overview of the market's top 5 risks of retirement, talk about producing income. We think that's one of the keys to success in retirement, and then our approach to financially living well in retirement. But before we jump in, I want to ask a rhetorical question. Why did you attend this webinar? There's dozens, if not hundreds of answers of why, but I would opine that all of those answers that you could give, and we listed a few of them there, everyone is looking for comfort, confidence, and clarity about their financial future. And that's the problem we're attempting to solve for clients. We want those 3 C's, comfort, confidence, and clarity. And so we think there's a bona fide process of how you get there. So we'll talk a little bit more about that later in the presentation. But quick question to warm up our brain. What was the annualized total return for the S&P 500, the largest 500 stocks, in the decade of the 1930s? We all remember what happened in the early 30s, the Great Depression, and what happened starting toward the end of the 30s, Second World War. But the answer, A, 0.0. So some consider that a lost decade in stocks. More recently, from about 2000 to 2010, you had another lost decade in stocks. So stocks for a prolonged period of time can go up, they can go down, but they ultimately can go nowhere. Quick overview of the market. This is our friend Yogi Berra. It's tough to make predictions, especially about the future. A little tongue-in-cheek there, but very true. So with these few slides here, we're not trying to predict the future. We're just trying to understand what we know and make what we think are good decisions based off that information. So here is what we think the expected path of inflation is. You've seen inflation come down since about the fall of 2022. We think that does continue. Our base case expectation is that at the end of this year, inflation is in the 2 to 4% range, which is what the Federal Reserve, Mr. Powell, has been hollering from the rooftops looking for over the past 12 plus months. Uh, Here's a look at the Federal Reserve, their tightening cycle. So as everyone knows, short-term interest rates have been moving higher. We think there's one, if not two more short-term interest rate increases this spring that could bring the cash yields up around 5%. It's our base case. We think that's pretty flat for the rest of the year, and then you start to see that move lower early part of next year. So only the good Lord knows, and he's not telling, but this is how this is some of the data we've used to position client portfolios on the fixed income, on the bond side for this year. But cash is a great option, where this time last year, cash really wasn't paying you much. You can get now close to 5% with some cash options out there. 2022, horrible year if you just own the overall bond market. The ag is what it is referred to as. We were very, I'd say, interest rate agnostic, meaning we took a lot less interest rate risk when compared to the overall market during 2022, with the thought that interest rates could move higher, which we saw. We've shifted our thoughts a little bit earlier this year, where we think bonds are a really interesting option with higher yields that we haven't seen in quite some time. So we think bonds have a okay to a good year. We don't think it's you're going to be up 10+% with your bond portfolio, but you look back at history, what you can see here, bonds tend to perform well after inflation peaks. We think we've seen the inflation peak. Bonds tend to perform well after the Fed stops increasing interest rates, and we think they stop increasing interest rates here in the next few months. So history does not repeat itself, but it often rhymes. We think this is a good indication for fixed income moving forward. Fundamentals are back in focus. This started last year. We think it continues into this year. This is a little bit of a busy slide, but what we're looking at here, the green box over here, the top quartile of low price to earnings, meaning companies that had the lowest price to earnings, some consider those the value stocks, did the best last year, where companies that had no earnings or negative earnings did the worst, as you can see in the red box there. We think what you own matters, and we think that continues into 2023. We continue to be big believers in big blue chip dividend aristocrat paying stocks that not only pay dividends, but historically have had a propensity to increase those dividends year over year. Last piece, kind of on our thoughts on the markets, we expect a mild recession sometime later this year. Maybe it trickles into 2024. Humans, we're all linear thinkers, and what I mean by that is if it's rained for the past 10 days, we say, oh my goodness, it's going to rain forever. And so when we think in a linear fashion to the past recessions, what comes to mind? 2020, during the COVID crisis, or before that, 2008, 2009, during the financial crisis. And in our humble opinion, we don't think that the recession that we may or may not experience this year or next year is anything like those two. We think it's much more mild. And the reason for it, we don't see any systemic issue like you had in 2020 with the pandemic, or 2008, 2009 with the whole mortgage crisis and the financial system really coming to the brink of falling apart. So we don't see that. And then also, consumer spending is slowing, but consumers in a much better spot than they were in 2007 when you go back and compare the two. So overall, we think there is a recession. We think the market has priced a lot of that in already, but those are kind of our thoughts on the market. We get just requests on, hey, we'd love to hear just your 50,000-foot view overview. So that is it. If you want to talk about it in more detail, please let us know. But let's transition to what we think are the top 5 risks of retirement. These are not the only 5 risks, but we do think these are 5 of the top risks that you should consider. Longevity being the first. The longer you live, the longer you're expected to live. Had a good question from a client earlier this week. He said, why are you expecting us to live a lot past the life expectancy that the United States produces almost every year? And I think that's a fair question, but it kind of is easily answered. The longer you live, the longer you're expected to live. And so these are the probabilities of a 65-year-old couple. It's kind of eye-popping. There's a 47% chance that one of you, if you're both age 65, have the chance to live to 90. So that number continues to creep higher due to medical advances, due to us understanding how to treat disease, et cetera. But we think you need to plan into your early mid-90s when looking at retirement. The second risk, inflation. Here's a look at the rule of 72. We think this is a helpful exercise. Take the number 72, divide it by the rate of inflation, and it will tell you how long it takes your cost of living to double. For example, 3% inflation, 72 divided by 3 is 24. So you say, well, inflation, we think it's going to be the long-term average, 3%. Your cost of living will double every 24 years. However, inflation probably closer to 6% now. If inflation stayed where it was now, your cost of living would double every 12 years. So every 12 years, you could see 2, 3, even 4 doubles, depending how old you are when you do retire. Third market risk is market performance. This is a little bit of a busy slide, so let me take a minute to explain it. The 2 boxes on the left are when you are still working. So for those of you that have not retired, you see that we're starting here with $100,000. We're averaging 7% rate of return, inflation of 3%. Start with $100,000, you get a bad return up front in year 1, 7% rate of return years 2 through 9, and a good 29% rate of return in the 10th year. You come out to $188,000. While you're still working, if you flip those returns, you get the good return up front, the bad return at the end. Down to the penny, you come out to the exact same dollar amount. So during your working years, your accumulation phase, the sequence in which you get your returns, it doesn't matter. However, let's shift our attention to the 2 boxes on the right. And during retirement, or the distribution phase, the sequence of returns matters a whole lot. So let's use the same returns. Taking out $10,000, starting with $100,000, you run out of money somewhere between years 9 and 10. However, with a good return, you end year 10 with over $52,000 left in the portfolio. So the point is, the first few years of retirement, those are the most important years to not stub your toe with a big downturn in the market. And that will go back to our process that we'll talk about on how do we invest the portfolio in retirement if we need to mitigate some of that downside risk, not for if, but when markets do move lower. Here's a little more information on that same topic. If you had a 20% downturn in your portfolio, you were taking out 4% from your portfolio per year, and assuming a 3% inflation rate, logic or intuition might tell you that you need 20% to get back to break even, but you actually need 36% to get back to break even in that one example. So it's a high hurdle. Being down 5, 10%, it's a lot easier to get back to break even than being down 20%. So we see a lot of clients, as they do approach retirement, start to shift their focus from trying to grow money to how do we protect money? How do we produce income with our money leading up to and also in retirement? Risk number 4 is investing without a process. A little bit of a busy slide. This grayish line is the overall S&P 500. And the blue lines are when people have added money into mutual funds and also ETFs. That's something that is public information that you can track. And what you can see here, the biggest outflows of mutual funds and ETFs happen really at the bottom of the market. End of 2002, after a 3-year downturn in the market, and end of 2008, early 2009, when the market made its low. So investing by emotion, investing by what you're feeling, is not a good strategy for long-term success. That's not our opinion, not only our opinion, but that's factually what, when we look at this page, what a lot of investors unfortunately do without having a process put in place. And then retirement risk number 5, healthcare. Study from last year, the average couple will spend over $300,000 in healthcare expenses from illness, injury, growing older, significant other spending projections in retirement. So a lot more than I would have guessed, if I'm being honest. But 46%, almost half of people that were polled thought they would need less than $100,000. So I guess I'm in good company on underestimating what the average couple will spend on healthcare expenses in retirement. Bottom line, we need a plan for these. We need a plan for potential long-term care. We need a plan for health expenses, not only Medicare premiums, but other expenses that do pop up in retirement from a healthcare perspective. So with that being said, how do we face these uncertainties? And we think the first step is to create a retirement roadmap. So we call our retirement plan a Live Well plan. We call it that because we're kind of cheeseballs and we couldn't come up with a better name. But we really do want our clients to live well. And this is helping us answer the question, how much money can we spend in retirement? How long will our money last? How much income, that's key, how much income do we need to produce in retirement? And then on top of that, we want to stress test your portfolio. What would our strategy have done in 2020 with the drawdown, in 2008, 2009? And we want to answer this from a quantitative but also a qualitative perspective, meaning can your portfolio recover based on the amount of risk you're taking, but what is your risk appetite? Are you going to be able to stomach a downturn in the market of 20, 30, 40% for a portion of your portfolio? And there's not a right or wrong answer. It's very dependent on each person and their investing experience and go down the list of different factors, but we want to make sure that your investment portfolio is tailored to what you're comfortable with, even if it's not necessarily the quote-unquote optimal way from what the numbers look like. Love this quote here by Benjamin Graham, who is one of Warren Buffett's mentors. The essence of investment management is the management of risk, not the management of returns. And we think that's very true in retirement. Step 3, maximize Social Security benefits. If you're married, there are over 80 different filing strategies that you can take for you and your spouse. If you are divorced or if you have a spouse that has passed away, that number dramatically increases. So a lot of planning that goes into place when looking at Social Security. We have a Social Security webinar that we do once or twice a year. That's all we talk about. So stay tuned if that is of interest. We have that coming up, I think, summer, fall time frame. But bottom line is this: we need to do some planning as it pertains to your Social Security filing strategy. And we never want the tax tail to wag the dog, but we want to promote income tax efficiencies when possible. And so this is not a comprehensive list, but these are just a few gifting strategies to maybe get you thinking on if you're doing everything possible to be efficient with your tax savings, with your investment portfolio, if you're still working, your W-2, your 1099s, etc. But a qualified charitable distribution QCD for short, you can take a portion of your RMD. You actually can do this starting at age 70 and a half, even though RMDs don't start till 73. You can give directly to a charity of your choice as long as it's a 501c3 organization. And that gift will count towards a portion of your required minimum distribution. So you get the most bang for your buck there, much better than giving cash after taking an IRA distribution, since it counts toward that RMD. We also talk a whole lot about gifting appreciated shares of stock. Let's say you bought a ABC stock for $10 a share, and it's now worth $50 a share. You can gift that stock at $50 a share. A charity gets to get the stock, sell it. They pay no capital gains, and then you can go back and rebuy that stock with cash and reset your cost basis, in this example, at $50 a share. So, easy way to get around some capital gains tax. If you have some appreciated stock, key piece here would be it needs to be in an after-tax account. This would not work for stock held inside a retirement account, 401k or IRA. And then bunching deductions, maybe a little less helpful now with the standard deduction moving up again for 2023, but paying property tax every other year, that depends on what your property tax bill is. Bunching some giving can also be something where you take the standard deduction one year and then the following year you itemize to get a little more bang for your buck. The next, we think, step at really trying to fight some of these risks of retirement we mentioned is cash flow planning. You can see there in the top right-hand corner, the rule of thumb, you'll spend 70 to 80% of your final year's salary. Obviously, that's different for every family, but a question that we would pose to you is 3% the new 4%? And I'm sure a lot of you on the call are familiar. 4% has been the rule for 2, 3, 4 decades. And you can take 4% out of your investment portfolio, get a raise on a regular and consistent basis for inflation, and assuming that you have a balanced portfolio, your money will break even or even grow during the duration of your retirement. And that's great. That's what has happened in the past. I think one can make a fairly compelling argument that moving forward, 3% could be the new 4%, just because interest rates are still today a lot lower than they were back in the 70s, the 80s, even the 90s when these studies were done. So that's one piece of just, I'd say, general counsel. We need to be really careful at what percentage of the portfolio we're taking out, and past history of what has worked may or may not work for us moving forward. Step 6, income-oriented investment process. So we're here at the Price Group, we're kind of a one-trick pony. We, for quite a while, have been big believers in dividend-paying stocks. And you look at a year like 2022 when the market was down 18 to 19%, dividend-paying stocks, you're going to clip a coupon, that dividend payment where you should have some downside protection for the total return of your stock piece of the portfolio. But here's a look at the total return as it pertains to what the dividends contributed by decade. And you can see dating back to 1930, 40% of the total return came from dividends. So not a rounding error by any stretch. We think dividends are really important while you're still working, but even more important as you do approach and enter retirement. And on that same point, here's a look at how dividend growers have historically compared into the overall stock market, non-dividend payers, and then what we really want to stay away from, the dividend cutters. So part of our process, if we ever get whiff of a company cutting their dividend, we're attempting to kick that company out of the portfolio prior to a dividend cut. And the statistics speak for themselves of why that is. But another key point is dividend growers in retirement. What this means is you're not only getting an income stream, but you should be getting an increasing income stream year over year to combat inflation. So step 7, we need to plan for long-term care. There's a number of ways we can do this, but I think the key point is let's make sure this is included in your retirement plan. And here are a few statistics. In 2024, the reported average has grown to 3.5 years of needing care in long-term care. And when we put this together, they hadn't come out with the 2022 number yet, but the 21 number was round numbers about 109,000 per year. If you're going to be in the heart of Houston, Texas, it's probably a little higher than the average. If you're going to be somewhere out in the country, probably a little bit less than the average. But the bottom line is we need to make sure we plan for expenses of this nature because we don't know what we don't know. And the final step we would say to combating the 5 risks of retirement we talked about, consider hiring an advisor. Emotions matter when investing. Look at the chart there on the right. You can see the average investor did worse than a residential home, bonds, the stock market, really any investment there listed outside of inflation. And a lot of that is because they bought and sold at the wrong time. They allowed emotions to take over, and that's what having an investment process really is combating. Mistakes, as you probably understand, are a lot more costly as you get closer to retirement. And with an advisor, you have options with potential alternative investments, individual bonds, strategies for additional income. All these strategies are not necessarily appropriate for everyone, but it is something to know that you have access to if it does fit your overall personal situation. So a little bit self-serving, but it's the statistics we think speak for themselves when looking at having an advisor. So we'll spend just 3 quick minutes here on our unique retirement planning process here at the Price Group. We think you need more than just an investment guy. We think we're pretty good at helping with the stocks, the bonds, but we think in retirement you need someone that marries all of this together. The insurance, if it's needed, cash flow, estate planning, tax planning, retirement, the investments, all of it together needs to be a cohesive and well-oiled machine where all the pieces are talking together. So someone who's just helping with the stocks or bonds may or may not be touching these other areas that are critically important as you do get closer to retirement. We develop a family index number. What rate of return do you need to be successful? This is not a cookie cutter approach where everyone has the same number. This is developed and tailored specifically for each family. And what we're solving for is how do we get there being the end of retirement, with the least amount of risk. We want the ride to be as smooth as possible, but also we want to do that from a standpoint, big drawdowns during retirement are how you stub your toe in retirement. And then creating a live well plan, back to the 3 C's, kind of where we started. We think everyone's looking for comfort, clarity, and confidence. And that's what we attempt to provide with this live well plan. And we'd be more than happy to do this on a complimentary basis. Just judging by the names I see here, we've done that for a few of you already, but would be happy to revisit that or to create that for you for the first time. And just kind of a final thought, if you are interviewing advisors, here are a few things we would recommend. We think this would be, take a screenshot of this or send me an email, happy to send this to you. These are some key considerations when you are interviewing an advisor. Are they serving as a fiduciary? And we think you're a fiduciary or you're not, and it's really hard, if not impossible, to be a fiduciary if you work at a bank or a brokerage firm. Do they have a cost structure you can understand? Is it transparent? What kind of experience do they have? Do they have credentials? Certified financial planner being the biggest. The CIMA designation, Certified Investment Management Analyst, being another big one that Randy and I both have as well. Is it a team or is it just an individual? And we think you should gravitate to someone who has a niche for the area of life that you're really entering into. And do you matter as a person, or are you just a number to them? We take a lot of pride in that we're a boutique shop. We're not trying to grow to be the size of one of these large firms where you call in and we have to verify your identity 3 different ways. We get to know clients on a personal basis. And then it's probably goes without saying, but someone that communicates well. Do you understand what they're saying, or are they using jargon that they're trying to impress you with some technical vernacular that may or may not even make sense? So we have a guide, 10 questions you should ask your financial advisor. If that's of interest, email me, and happy to provide that to you as well. But wanted to say thank you for attending. That's myself, Matt Price, Randy, Maddie Kearns, Tiffany, and Melissa. If you have any questions, please let us know, and we are here to help.